All right, everybody, it's Jeff Phillips at Accounting Fly. We're getting started with session 2 of the Test Prep Forum 2016, CPA Test Prep Forum. Do me a favor if you're in the audience, you have a control panel on your GoToWebinar control. Fire off just a quick confirmation that you can hear me. I want to make sure I'm coming in loud and clear. I'll give you just like 5 or 6 seconds to do that. Awesome. Thank you, guys. Thanks for being here. So I'm calling in from Pensacola, Florida. It is feeling like summer already. It's May 2016, and I hope you're wrapping up the school year. You're probably here because you are going to be taking the CPA exam in the next few months, so your timing is ideal. Why are we doing this? So obviously passing the CPA exam is critical to your career. You earn a lot more money, if there needs to be a better reason, when you pass a CPA exam. And a plethora of other benefits. And to do that, you need to have the right coaches, the right teachers and mentors to get you across the finish line. And that's why we're doing this. That's why we're partnering with our amazing partners like Surgent CPA Review, who bring some of the most robust teaching resources in the market. There's a lot to learn about Surgent. We'll talk about them in a little bit. Because they have some exciting offers. And if you stick around, they even have a 20% discount on one of their core products and an amazing prepayment plan that you need to check out, but more on that later. So we're gonna be discussing bonds, which I was telling Liz earlier, a topic I did not handle well in college myself. So I'm very eager to finally master this topic. And you know it's going to be on the CPA exam. Let me introduce Liz. And Liz, as I'm introducing you, say hi, and I'll make sure your mic works. How you doing today?
I'm doing great. How are you, Jess?
I'm great, Liz, and you sound fantastic. A little bit about Liz. Liz Kolar's a CPA. She's a CGMA. Been teaching CPA review for 25 years here in the United States. Liz, you have personally taught more than 2,500 live sessions. I'm amazed.
Yes.
Wow. You've been busy. Liz, you've helped thousands of candidates pass a CPA exam. For those of you who don't know Liz, she began her career in public accounting with a Big Four firm. She founded Pinnacle CPA Review and co-founded Surgent Kolar CPA Review. Liz, you're a master teacher, and we love having you on these webinars. So I'm so glad you're here.
Thank you.
A couple of things before we hand it over to Liz is I want to do a couple quick polls, if you don't mind, everybody, as you're logging in. We want to know exactly who you are so that we're targeting the message to where you're at in your career. So humor me, if you will, and do a couple of these polls real quick. So here's number one. Where are you in your career? I'm going to give you about 30 seconds, super easy. Just select one of the following. Are you an undergraduate, a graduate student, you're a professional with 0 to 2 years, or are you 2+ years? And while you're filling that out, I got to tell you, if you're 2+ years of experience in public accounting and you're looking for a new job, you're in high demand. Now, once you get that CPA, your demand is off the charts. So that's why you got to get this exam going. But if you do have 2 years of public experience and you're looking for a new job, you can email me at jeff@accountingfly.com. We'll get your resume over to one of our hiring advocates who can make introductions to recruiters at accounting firms in your location. Okay, so Liz, just so you know, 55% of our audience today has 2+ years accounting experience.
Okay.
25% are currently accounting undergraduates, 8% are graduate students, and 10% are accounting professionals with 0 to 2. So good to know, right?
Yep.
And then while we're at it, we have one more poll we're going to ask you. And I appreciate everybody answering these questions. So this is when you're going to take the CPA exam. You wouldn't be here if you weren't planning on it, probably, unless you just like the sound of our voices. Let's give you maybe 15 to 25 seconds. Please fill this out. So already, Liz, I can tell you that it's trending to be about 70% of our audience will be taking it within the 12 months. And 20, it's fluctuating, but about 75-25% will be taking it in 12 months, and 25% will be taking it 12 to 36 months. Okay?
Okay.
All right. So that helps us know exactly where you are at. Liz, I think what we're talking about today is extraordinarily topical. Folks, ask questions of Liz. It's a rare opportunity to have a master CPA exam teacher give you this much attention and coaching. Ask questions. Valerie from Surgent will be on hand to answer the questions in the text channel, and then she will be promoting some of the questions for Liz to answer at the end. So fire them off. Now's your chance. So we'll do that Q&A towards the end. So Liz, I'm grateful for you, and I'm glad you're here. And I'll chime in towards the end with Q&A, and I want to tell everybody about some of the offers that Surgent is offering. But take it away, all right?
All right. Well, thank you everybody for joining us today. Jeff had reached out to me a couple of months ago and asked if I would be willing to teach a topic on the CPA exam, and he wanted to know what topic I would teach. And I thought long and hard, and I thought, well, let me pick a topic that I know students struggle with a lot. And so, of course, I landed on bonds. I've been teaching at the college level for about 30 years, and no matter the level of student I run into, bonds seems to cause a great deal of discomfort for students. So I thought I would tackle this topic for you. My goal today is to share information about the bond area and to also show you some CPA exam questions. But I thought I'd start out with just an introduction on what bonds are. First of all, they're simply debt instruments, and corporations issue them, governments issue them. A bond issuer will pay a fixed amount of interest for a specified period of time. Usually the interest payments are made semi-annually. Some bonds pay interest annually. And at maturity, the bond issuer will return the bondholder's money, the full amount that they lent. Now, bonds are usually also sold in increments of 1,000, so that's something standard that we usually see on the CPA exam as well. Now, it's really important that you understand how interest rates affect the bond. So if a bond is issued at par, that means it's issued at its face amount. Now, when is a bond issued at par? It's when the stated rate of interest equals the market rate. Now, you have to know the different terms the exam uses for these rates, so let me review some of the terms they use. The stated rate may also be called the face rate. Could also be called the coupon rate. So stated, coupon, face, these rates are actually printed on the bond certificate, and they don't change over the life of the bond. Now, the market rate is also known as the yield or effective rate, and that's the rate that fluctuates. So if a bond is sold close to the date that it's printed, it's usually issued for its face, and it's issued at par. Now, what happens when a bond is issued at a discount? So that means the bond is issued for less than par. So what's happened is the market rates have changed, and in fact, the stated rate is below the market rate. So the stated rate on the bond is not as attractive as what an investor could get in the open market. And so the issuer has to lower the price of the bond, issue the bond at a discount. Now, if a bond is issued above par, that means it's been issued for a premium. Now, why would a bond issuer get to issue a bond at a premium? It means that the rate that's being offered on the bond is higher than the prevailing market rate. So an investor would get a more attractive rate by buying that bond that's currently being offered in the market, and so the bond issuer can charge a premium for that. So I thought we would just do a short exercise on playing with these interest rates to make sure you understand how the market impacts the issue price of a bond. So let's assume that the stated rate of interest is 7%. That's printed on the bond certificate. The market was currently at 8%, what would the bond be sold at? You got three choices. You have a discount, you have a premium, or you have par. So if the market is 8 and the bond is only paying 7, it's not very attractive right now for investors. So the bond issuer would have to offer that bond at a discount. Now, if the market rate is the same as the stated rate of interest, this is where you have a bond being issued at par. So if it was a $500,000 bond, it would be issued for $500,000. Now the last scenario, the market rate 6% and the stated rate 7%. So the bond is offering a higher rate of interest than the market. the bond issuer could charge a premium for that bond. It would be issued above par. So hopefully that clarifies how interest rates affect the bonds. Our first really important thing I want to go over with you today is how to calculate the price of a bond. The exam, the CPA exam, heavily tests bonds, and I want to warn you that you could get bond questions in the financial accounting reporting section, most likely. That's where you're going to see a lot of them. But they also ask bond questions in the audit section and in the business environment and concept section. So you can't escape them no matter how hard you might want to. So the first topic, as I said, I want to go over the issue price of bonds. And one of the things I find with most students is they get overwhelmed by the amount of information they see in a bond problem. You're going to be given interest rates, dates, a lot of facts, and it can be very, very confusing. So let's clarify the interest rate situation. We have to calculate the present value of the cash flow streams of a bond. Now, when we calculate present value, we always use the market rate or the effective rate. The only time we use the coupon or stated or face rate on the bond is only once, and the only time we use it is to calculate the interest payment that the bond issuer is going to make either semi-annually or annually. So most of the time in bond problems, you're going to be focusing on the effective rate or the market rate. The coupon rate is only used once, and that's to calculate the interest payment. So be really careful that you do not mix up these dates when you're solving the problems, because the examiners anticipate that you will, and oftentimes they'll put answers in there assuming you flip the rates. And I know this can be very tricky, so just take time when you get a bond question and make sure you clearly identify what the market rate is versus the coupon rate. Now, it's also important that you know how to calculate the stated interest payment and also how to calculate the interest expense that's going to accrue on the bond. So first off, let's go over how we calculate the interest payment. The interest payment is always calculated by multiplying the stated rate by the face amount of the bond. So the par value of the bond. The stated rate's the coupon rate. Now, the effective interest expense, notice the difference. We use the market rate or the effective rate, and we multiply that by the carrying value of the bond. Now, what's the carrying value? The carrying value is the face less any discounts or the face plus any premium. Okay? So it's really important that you know how to do that too. Now, calculating the issue price of the bond involves two calculations. You have to sum up the two cash flow streams of a bond. Then what are those cash flow streams? Well, at maturity, the bond holder is going to get the par value of the bond back. And during the life of the bond holder will get interest payments. So we have two different streams. We have to calculate the present value of the face amount, which is the present value of one lump sum. And when we calculate the present value, we want to make sure we're using the appropriate number of periods and the appropriate interest rate. Be very careful when you get a bond problem, though, because sometimes they'll say that the bond calculates interest annually or the bond calculates interest semi-annually. If they tell you that the bond is paying interest semi-annually, you have to take the market rate and divide by 2. You've got to cut it in half. And the maturity period, the N, would have to be doubled. That's something that most problems you're going to encounter when you do most bond problems. The same is true for the interest payments. Now recall that when we calculate the interest payment, we use the coupon rate and multiply it by the par value. That's the only time you're using the coupon rate. But then you want to take the present value of that annuity, because it's periodic payments over the life of the bond, being sure that you're using the appropriate N and the appropriate I, or interest rate. So what I like to do when I teach is in every lecture, I will go over lots of problems in class. And so what I want to start with is some strategy before we even dive into a problem. When you see a question like this on the CPA exam, first of all, I want you to notice there are an awful lot of numbers in this problem. And I know my heart starts to palpitate when I look at it. I can imagine how you feel. I've been teaching this for 30 years. So what's the best strategy when you get any lengthy problem on the CPA exam? I want you to go to the question first. So kind of skip over all that you're seeing there and just find the question. Now you can see here I've highlighted it. It's down at the bottom of the slide. The question is, what's the issue price of the bonds? If this were in a multiple choice format on the exam, what would be below that? What would be below that are the choices that they're giving you. So you can always find the question sitting right above the choices on the exam. And then once you read the question, I want you to go back to the top of it and carefully go through the data that's provided. So what I've done here is I've highlighted some of the key things that we need to be careful of as we read this problem. So we have on January 1, Detweiler Company issued bonds with a face value of $1 million, has a stated interest rate of 8% per year, payable semi-annually. The bonds were sold to yield 10%. They give you present value factors. So what are the key factors you need to identify here? Well, you need to know what the coupon rate is. The coupon rate is 8% or 4% semi-annually because it's a semi-annual interest payment. And then I want you to calculate the coupon payment right away. So we're going to take that semi-annual interest rate times the par value of $1 million to get $40,000. We identify the market yield in the problem, or the effective rate, that's 10%, but we have to cut it in half because we're doing semi-annual interest payments, so the market rate we're going to be using is 5%. The bond was a 10-year bond, but because it's semi-annual, we're going to adjust that to 20 periods. So the factors I need when I'm picking my present value factors are the semi-annual interest rate, 5%, and the 20 periods for the bond. And so when I bring us back and show you the present value factors, you can see here that the factors we need involve not the 10 periods, but the 20 periods at 5%, yes? So we're going to be looking at the 377, the 0.377 for the present value of 1. And for the interest payments, we're going to be using the present value of the annuity for 20 periods at 5%, or 12.462. So once you find that, once you determine your present value factors, and you've calculated your interest payments, the rest of the problem is pretty easy to solve. We're going to calculate the present value of the face of $1 million multiplied by the present value of 1 factor of 0.377, and then the present value of the interest, which is the $40,000 interest payment multiplied by the annuity factor of 12.462. You sum up those two payment streams and the issue price would be $875,480, and that supports the bond being issued at a discount. So now what I'd like to do is actually walk you through a full multiple choice question. So what is the strategy we use here? We have this big problem. What was my advice? Read the question first. So what amount of proceeds on the sale of bonds should Young report? So I find the question, I know what I need to do, now I go back to the top and I read the facts. It says Young Company issues $800,000 of 10% bonds, so that's the coupon rate, dated January 1, year 1. Interest is payable semi-annually on June 30th and December 31st. The bonds mature in 5 years. So it's a 5-year bond, and the current market rate is 8%. So let me ask this question. If the bonds have a stated rate of 10% and a market rate of 8%, would this bond be issued at a premium, discount, or at par? Well, we know it's not par because the market and the coupon rate are different. The answer is a premium, right? Because the 10% is higher than the market rate of 8%. So what are the facts we need to know here? Well, the coupon rate semi-annually would be 5%. The interest payment would be $40,000 or 5% of $800,000. The market rate, although it's 8% annual, we need 4% semi-annual to do the calculations. And the bond term of 5 years would be converted to a 10-period present value factor. So when I come back to the problem, I know I need an N of 10 and an I of 4. And these are the two factors that I need. For the interest payment, I would be using the 8.11 annuity factor, And for the present value of 1, I'd be using the 0.67556. All right, now you've analyzed everything you need to know. You just need to compute the issue price. So I would take the present value of the face, the 800,000, multiply it by the present value of 1 factor, and then I would take the present value of the interest, the $40,000 payment, and multiply that by the annuity factor of 8.11. You do all the math, you work it out, and this is where you kind of have that moment of slight panic because you're praying that this answer matches the choices in the multiple choice question. So we're looking for 864, 884, and when I go to that choice D, there it is, choice D, I can relax, I found the answer. All right, so that's how you solve a bond issue problem. Now what I'd like to do is go over how we calculate and account for bond discounts and bond premiums. So to illustrate how to account for a discount, I thought I would do a multiple choice question with you. So what's our strategy here? I got a big problem in front of me. What's the strategy? The first thing I want to do is read the question. All right, so we go down to the bottom, right above the choices. In its June 30th balance sheet, what amount should West report as bonds payable? All right, so now I know they're asking me for bonds payable. Let's go read the top facts of the problem. Now, something I want to draw your attention to here is the question said June 30th balance sheet, but the bonds here are issued on January 2nd, 2015. So let me warn you, in bond questions, and you see this in leasing questions and other types of problems on the exam, you have to pay attention to dates. Be very careful because they often ask you things that you're not expecting. For example, here I see the word annually, but when I look at the dates, they're asking me for a semi-annual amount. If I wasn't careful, I might have missed that. So make sure you read the problem very carefully, take your time, and watch out for those dates. So we have on January 2nd, West issuing 9% bonds, so there's my coupon rate, in the amount of $500,000, that's my face. They mature on January 2nd, 2025, so we get 10-year bonds. They were issued for $469.5, so we got a discount to yield 10%. That's our coupon rate. I'm sorry, that's our market rate. The interest is payable annually on December 31st. And they use what's called the interest method of amortizing bond discounts. Now, this is also referred to on the exam as the effective interest method. The alternate method would be the straight line method. And I have to tell you that most often the examiners ask you to calculate using the interest or the effective interest method. It's a little bit more challenging than the straight line method. So that's the method I want to review with you today. So before we get into the calculation, though, I'd like to just show you the journal entry of the bond issuance. They issued the bonds for $469.5. They have a face, a par of $500,000. So the discount is the difference. The discount is $30,500. And I know it has to be a debit because they received less proceeds than the actual face of the bond. Now, when I'm teaching bonds, I often recommend that students set up an amortization table. I find this helpful so that you can organize the facts of the problem. The cash payment is based off of the coupon or stated rate. The interest expense is calculated using the market rate. Now, you'll notice I've cut those rates in half based on the problem because the question asked me to compute the bond payable 6 months into the issue. So that's why I cut it in half, even though it says they pay interest annually. Now, the cash payment is based off of the face of the bond. So the stated interest payment would be the face of the bond of $500,000 at 4.5% or $22,500. The interest expense, if you recall from my earlier note, is calculated based off the carrying value. And the carrying value is $469.5. We multiply that by the 5% interest rate. So the interest expense is $23,475. Now, I want to just point this out. This is a really important thing to note. When a bond is issued at a discount, Is the interest expense higher than the cash payment? Yes, it is, right? And that happens when a bond is issued at a discount. Interest expense ends up being higher because they have to pay the investor more money to match what's happening in the market. Now, discounts are amortized simply by taking the difference between the cash payment and interest expense. So the amount of the discount that would be amortized in this problem would be $975. Now, what do we do with that? I'll come over here to my carrying value column. When you look at this, it's important to note that the carrying value has to end up being $500,000 at maturity. So this value has to increase over the life of the bond. So what do I do with the $975? I add it. And so the carrying value after the first 6 months would be $470,475. I'll go back to my multiple choice question. You can see that's choice B. All right? Now, I'm not going to go a little further with this. I just want to practice one more row with you, make sure you feel good about it. It's important to note that my interest payment isn't changing here, right? It's going to stay at the $22,500. Will the interest expense change? Yeah, it will. Why? Because the carrying value has changed. If you take 5% of the new carrying value of $470,475, the interest payment is $23,524. How do I find the discount? I take the difference between these first two columns. Discount ends up being $1,024. I would add that to the previous carrying value of $470,475. And so the carrying value at the end of the first year would be $471,499. All right? Let's try another question. Now, hopefully by now you feel comfortable with strategy. What am I going to tell you to do first? Of course, read the question. Let's take a look at it. In its October 31 balance sheet, what amount should Benford record as the unamortized bond premium? Okay, so they're asking me for something completely different than anything we've looked at before. Really important you pay attention to that. All right, so we've read the question. Now, obviously it's a premium. Let's go through and read the rest of the facts in the problem. It says on May 1, year 3, Benford issued 11% 10-year bonds in the amount of $1 million. The bonds were issued to yield 10%, and it resulted in a premium of $62,000. So they're not asking me to calculate the issue price or anything like that. They're giving me those facts. It tells us that Benford uses the effective interest method to amortize the bond premium, and interest is payable semi-annually on November 1st and May 1st. So you can see these are odd dates here. So they issued the bond on May. We have November 1st being the interest payment date, and they're asking me to calculate the unamortized bond premium as of October 31st. See what I mean? I think, all this stuff can just wear you down. So what am I going to do first? I'm going to show you the journal entry. This is a premium, so we debit cash for $1,062,000. We credit the premium on bonds payable, and we credit the bond payable for the face amount of $1 million. As I suggested before, I always like going back to that amortization table. It sets up things so nicely, especially in the stress of an exam. So the coupon rate was 11%. The market rate was 10%. So I'm cutting those in half to calculate my cash payment and my interest expense. So I'm basing the interest payment off of the par value of the bond, the $1 million. So the interest payment would be $55,000. The interest expense is based off of the carrying value. So I'm going to multiply the $1,062,000 by the market rate, the half-year market rate of 5%. So that gives me an interest expense of $53,100. Now notice the difference here. This is the exact opposite of the scenario we saw with the discount. The premium interest expense is lower than the interest. And that's effectively what a premium does. It lowers the overall interest expense on the bond. Use my earlier example. If the bond was paying 7%, but the market was only paying 6%, the bond issuer is going to make interest payments that effectively reduce the market rate to the lower rate, to reduce the interest expense to the lower rate. All right, so how do I get my premium amortization? Just take the difference in the first two columns. So my premium would be $1,900. Now, looking over here, I've got $1,062,000 as my initial carrying value. At maturity, what does the carrying value need to be? It needs to be $1 million, the par of the bond. So what would I do with the $1,900? I would subtract it. That's right. That would be $1,060,100. Now, have I actually figured out the answer to the question yet? No, not yet. The question asked me for the unamortized premium. So what I would do is I'd take the premium that we started with of the $62,000 and deduct the amortization. So the unamortized premium, the end of the first 6 months, would be $60,100, and the answer would be choice B. I know, it's crazy stuff, right? Now just let me show you how the premium would be reported in the balance sheet. If the bond had a face of $1 million, the unamortized premium of $60,100 would be added to the face of the bond, and it would be reporting at that date a carrying value of $1,060,100. All right, so like we did the discount, let's do one more row just to make sure you feel good about it. How do I calculate the interest expense? I'm going to multiply the 5% by the new carrying value. That's right. So the interest expense would be $53,005. The premium amortization is the difference between the first two columns, or $1,995. And I deduct that from the previous carrying value. So my adjusted carrying value at the end of May, or at the end of April, would be $1,058,105. Now, just to expand our discussion a little bit, I thought I'd show you the journal entries too. On April 30th, they're not actually making the interest payment, so we have to credit interest payable for the payment calculation of $55,000, but interest expense is the $53,055. So you can see here in the entry that expense is less than the amount that's paid, and the premium is amortized by debiting it. And then on May 1st, when they actually make the payment, they would debit that interest payable and credit cash. All right? Hopefully you're still holding up okay. I know I'm covering a lot of stuff today. While we're here, I thought I'd show you how we record investments. So we're going to take a look at the flip side of the bond debt transaction and look at what a bond investor would record, because you could get questions like this as well. So when a bond holder buys the bonds, they have an asset. We call that investment in bonds. And the investment cost includes not only the price they paid for the bond, but any investment fees or commissions that were also paid. So let's take a look at another multiple choice question. Here we have a Fisher purchased 400. So this is a little different than what we've looked at so far. We're talking about an investor, they're buying the bonds. When we're talking about a debt, they've issued the bonds. So that's an important point to note. So strategy always is read the question, right? We want to find out what the bond should be reported at December 31st on their balance sheet. And then I go back and I highlight the facts. Now on the CPA exam, you are going to be given a board and a pen where you can write facts down. And you know, I do recommend that when you get a question like this with lots of numbers, lots of facts, you identify the key factors and jot them down if you feel comfortable doing that. So we have on July 1, 2017, Fisher Company purchased 400 of the $1,000 face 8% bonds of Dole for $369.2. So the coupon rate is 8%. Now that $369.2 was to yield 10%, so the market rate was 10%. So the bonds were issued at a discount, correct? Because the face of the bonds would be $400,000. Now the bonds mature on July 1, 2022, and they pay interest semi-annually on January 1, July 1. I love it when it falls right on the first day in mid-year. Makes it a little easier. Fisher uses the interest method to amortize the bonds and appropriately records the bonds as a long-term investment, which is how you would normally classify in bond investment. So again, what I would like to do is set up an amortization table, but this one, notice that the terms have changed. We're not saying cash payment or interest expense, we're showing cash received and interest income. And I don't have a discounted premium here. What I have instead is the investment is amortized. So we're starting off with the carrying value of the acquisition cost of $369.2. But theoretically, we're following the same process. The cash payment, or the cash received in this case, would be the par times the coupon rate divided by 2, or 16,000. The interest income is the carrying value of 369.2 times the market rate, total of 18,460. So the investment would be amortized by the difference of 2460. Now, what do we do with that? Well, at maturity, what is the bond purchaser going to get back? The bond purchaser is going to get back $400,000. So what do we have to do with the 2460? We have to add it. And so the carrying value of the bond at the end of the first period would be $371,660. And if I go to my multiple choice questions, sigh of relief, there it is, choice C, $371,660. Excellent. Let's look at some journal entries just to wrap that whole area up. When the investor buys the bonds, they would debit investment in bonds and credit cash for the price they paid. Now, at 12/31, they're going to debit interest receivable. They're not going to debit cash, a little trick there, because the interest payment wasn't going to be received until January 1. And notice what we do for the amortization. We actually debit the investment in bonds account directly. So we're increasing the value of the bond account, investment in bonds account, by the amortization amount. And the full amount is recorded as interest income. And so the carrying value of the investment started out at $369.2. It went up by $24.60. So the total value is $371,660. So what I wanted to show you there is there are different ways of solving these problems. Over the years that I've been teaching, I find that a lot of students like to go back to the amortization table because it just lays everything out very nicely and you're less likely to make a mistake. The more experience you have with bonds and the more comfortable you get with bonds, the more likely you are to use shortcuts to solve them. But that takes a lot of practice. And so, if you feel that you're more comfortable using the amortization tables, it really doesn't take that much extra time to solve them, especially when on the CPA exam, you could get this as a multiple choice question, but you could also see this as a simulation. And you could imagine the simulation. I know. It's a whole set of facts where you have to complete the entire amortization table and then also show all the journal entries. So that was part of the reason I wanted to show you everything in today's lecture, so that no matter what you get on the exam, you'll be prepared. Now, to finish up the investor side, at maturity, what happens? The investor gets the $400,000 back, so they debit cash and credit the investment in bonds. All right. So this brings me to my last area that I think I have time to go over with you today. And it's a pretty challenging topic. It's when bonds are sold between interest dates. So the way bonds work is the bond issuer is going to mail the 6-month interest check to who's ever holding the bond at the interest payment date. What can happen, though, is that bond could have traded hands in between. So if an investor buys a bond from another investor and it's maybe 2 months into the 6 months of the bond, the investor has to pay the person who they're buying the bonds from the accrued interest up to that date of sale, because at the interest payment date, the investor is going to get all 6 months. Who's ever holding the bond is going to get all 6 months worth of interest. So let's do a little problem here together. Assume we have a $10,000 bond issue. The rate is 6%, and the bonds were sold on September 1st. The interest is paid semi-annually, and the interest payment dates are June 30th and December 31st. Okay, so this is the fact pattern I'm going to use. I'm not going to factor in any discounts or premiums here. We're just going to keep this pretty straightforward. So we have a little saying we use a lot of acronyms when we prepare candidates for the CPA exam, so I have a little acronym for you today. Interest is in the pits, and P stands for principal, I stands for interest, T stands for time. So if the bond is being sold on September 1st and the last interest payment was made on June 30th, there are 2 months that have elapsed that the bond purchaser needs to pay the bond seller for. So how would we calculate that? We would take the $10,000, multiply that by the 6% interest rate, and it's 2/12. So the bond purchaser has to pay, in addition to the $10,000, $100 worth of accrued interest. So let's look at the journal entry. The issuer would debit cash for $10,100. They would credit bonds payable for $10,000, and they would credit interest payable for the 2 months of accrued interest that they received. Now, the investor, on the other hand, would debit investment in bonds for $10,000, debit interest receivable for the $100, the 2 months worth of accrued interest, and credit cash for $10,100. When the interest payment is made, the investor would, I'm sorry, I jumped ahead there. The investor would debit cash for all 6 months worth of interest, but only 4 months represents interest income, because the $100, the 2 months, they didn't actually earn the interest, they didn't hold the bond. And you can see the issuer would debit interest expense for $200, reverse the interest payable they set up, and make the cash payment for all 6 months, totaling $300. All right, so that's a little overview of a more challenging area of bonds sold between interest dates. Now, I want to warn you that there's a lot more to bonds than what I was able to cover today. What we do at Surgent is we take these topics that are really challenging and we break them down into smaller, nano-sized lectures. So I've been speaking for, I don't know, maybe 35, 40 minutes. Our lectures are usually not that long. The topics that I taught you today, I would have broken out over 3 or 4 separate smaller lectures that would have focused in on just one of the topics. When I designed Surgent CPA Review's curriculum, I felt that basically the CPA Review arena needed a massive overhaul. I personally feel students are studying too much information, and we're finding that candidates can't finish their studies in the time allotted in order to pass the CPA exam. And what we're seeing, unfortunately, is a downward trend in pass rates, because candidates just can't finish everything in 18 months. The authoritative bodies have not been all that cooperative either. If you look at what the FASB's been doing, they've been issuing pronouncements every other day. The AICPA is revising the audit standards and the review standards and the attestation standards. And you, as a candidate, just getting more and more and more information dumped on you, sorry to say. So when we designed Surgent, we wanted to, number one, take into account the way you learn. And there have been a lot of studies done, and what we found is that your attention span now is about 22 minutes. After 22 minutes, you kind of tune out. So think of yourself, you're hanging on. I see that you're still participating in the lecture, but it's hard to focus for that length of time. Plus, you're all really busy, and you might not have an hour or 2 hours, or heaven forbid, 4 hours to sit through a lecture. So we decided to break down all the content into smaller, what we call nano-sized lectures. To be honest, we have over 350 of them. But I'm going to tell you something really important. With our design, you don't have to watch all the videos. Surgent has invested a lot of money in designing a new technology where we incorporate adaptive algorithms. So we're the only course in the country that has this revolutionary technology. And what we do is we have you start by doing a practice test, doing some practice questions, and the software figures out what you know, but more importantly, what you don't know. And then we design for you a customized study plan that focuses just what you need to study. So yes, I might have 350 videos, and we have thousands of questions and hundreds of simulations, but as a candidate, you don't need to do all that work. You need to study what you don't know. So in the bond lectures after today, you might not have to revisit the bond lecture on discounts and premiums because you know it. Save that time and focus in on your weak points. The goal of our program is to get students to pass the exam faster with less study hours. And the results have been phenomenal. Our average candidate spends about 95 hours studying for one section, and our pass rate's among the highest in the nation. We have over an 89% pass rate for our students. We are so thrilled with the success of the program that we do offer a guarantee, and the guarantee comes in one of two ways. When you enroll in Surgent, the course does not expire. We'll stay with you until you pass. We also have a money-back guarantee. If you do the course, take all 4 parts, and don't pass the CPA exam, we'll refund your tuition. So we back up our promises with that guarantee, and I'm so thrilled with the results. So today we wanted to put together a very special offer for you. I know it's really hard oftentimes, especially if you're right out of college, maybe you just started a new job. It's hard to come up with the money to pay for a review program. So we're rolling out a pretty phenomenal offer. We will get you started in Surgent for only $49. And the payment plan that we offer is $49 down and $149 a month, and that payment will be made over 10 months. Our course retails for $15.95, so this program incorporates a discount. There's no credit check, so you don't have to worry about that, but it gets you started at a low price so that you can see how strong the program is and you can have early success. We also offer a free trial, and you're welcome to sign on that on our website. We also do onboarding webinars, and so if you have time and you want to meet one of our accounting coaches, we can work with you online and show you how the program works. Now, Jeff, I'm going to turn it over to you now, so you can talk to the students about the other offer that we have.
You got it. Liz, by the way, I think I understand bonds now.
Yay! Awesome.
When you explain the difference between what creates a premium, what creates a discount, I finally that was a big missing piece for me, and that was the first thing you covered. So thank you. So I know that we've already sent out through the panel the $49 in month one and the payment plan that you just talked about. And you guys also have another offer for the Accounting Fly audience, which is 20% off of that core product, which I think that you said retails at about $15.95.
That's right.
20% off, and you can take advantage of that from now until the 1st of June. We're going to send you that link out throughout, and just went out. So you can click on that link that we just provided. It'll open up in a new browser, so you can take a few minutes and check that out. Of course, we'll send this out over email as well. I do have a few questions, Liz, but I didn't want to steal thunder here. We've got 2 really exciting offers on the table. You've talked about what makes Surgent such an outstanding product, but before I move on to questions, were there any other information you wanted to make that differentiates Surgent?
Absolutely. Well, our team of instructors are leading experts in the industry. Jack Surgent has taught probably more live sessions than I have. Surgent Professional Education is the leading provider of CPE in the nation. And so our team is by far the most experienced educators in the country in CPA review. When you enroll in Surgent, you get everything. So we don't have any additional add-ons that you have to worry about, no hidden costs. Our course includes textbooks. It includes a flashcard app, unlimited access to multiple choice questions, simulations, and practice exams. So as part of Surgent, you get into the course by doing a practice session, and then we figure out what you do and do not know. And the adaptive technology works with you to build your weaknesses into strengths. And when you get to the point where you're almost ready to sit for the exam, we give our candidates the opportunity to take a practice exam. Now at Surgent, you can take as many practice exams as you need. You should at least do one. And we offer in our program a really unique feature. Candidates can see right on their dashboard what their score is. And I tell my students that, if you're hitting a 75 or higher in our software, you'll know it, you'll see it right on your dashboard. That means you're actually ready to take the CPA exam. And I don't think any other review course out there has that. And I know I've heard that from students all over, that they're not sure when they should take the test. They've been studying for months. When are we ready? Well, I'm going to tell you, you'll know exactly when you're ready with Surgent, because you'll see your passing score. Now, I'm a little conservative. Passing is a 75, so I'll probably recommend you get a little higher than 75 while you're studying to ensure that you pass. But it's a neat feature that we include in our course, so we don't limit the types of questions that students have access to. Also, Surgent is fully prepared for the 2017 CPA exam. We already have the new document review simulation in our software. We were the first review course to provide that to our students. And we have already prepared hundreds of enhanced task-based sims that will be introduced on the CPA exam on April 1st, 2017. So our course is fully ready to go for the new exam. I heard some of you are thinking about taking the exam in the next 12 months. My advice is, if you can take the exam before it changes, you should try and get it done. Because the exam is going to test higher order skills, and it's probably going to be a more difficult exam starting in April 2017. So if you have the opportunity to pass it before those changes go through, I recommend that you try and do that. The other thing I tell students is, and this is going to sound weird coming from an educator, I actually don't want you to read our textbooks. I know that sounds weird. I've tried myself to read accounting books, and I know that I can't do it. I usually think about the pretty day outside or the laundry I need to do. It's tough to read accounting textbooks. So the way we design our course is that each of the questions that you do links directly to the part of the book that references the topic. If you get a question wrong, that's probably something you'll want to read, but you don't need to read cover to cover. You only need to read the things that you don't get right. And that also saves a lot of time. So that's also unique about our course.
Well, you answered one of the first questions we got, which was, how does Surgent approach the coming changes? And well, a lot of the changes are even in effect. So thank you for getting ahead of that one. A few questions I want to ask while we still have a few minutes, and thanks to everybody for getting some great questions to us. So one of the questions was, is it okay if I watch your videos first and then do the questions? But as I understand it, the way Surgent operates is you want your students to answer your questions first, so that you can assess strengths and weaknesses, and then watch videos and take curriculum based off where the weak points are. Do I have that right, Liz?
Well, Jeff, we do recommend using the adaptive technology, and that would mean letting us test drive. Let us help figure out what you don't know. But plenty of students are not comfortable with that approach. So we do offer another option, and it's built into the dashboard, where the student can pick and choose what they want to study. In fact, we designed this so that we could partner with a lot of schools and universities. Professors are using our course in classes, and students are having the opportunity to use the database and use the videos to flip the classroom. And in that case, they're actually watching the videos first. So, I've had students use both. While they're in the course, they start out with adaptive, then they maybe switch over because they want to watch a video and they want to choose what they want to do. It's all possible within our program.
That's fantastic. Okay, does Surgent have a list of all the acronyms that are used? And there are a lot of them.
Yeah. Well, with each video lecture, we prepare a customized study guide that goes along with that video lecture. And in the video lectures, in the study guides, we do have the acronyms that we use, so the students do have those at their fingertips. It isn't necessary, in my opinion, to memorize every acronym. You're probably going to only need to rely on the acronyms in areas where you are weak. So if you're following our adaptive approach, you'll have access to everything you need to build those weaknesses into strengths.
Liz, how long does Surgent recommend a student spend studying for the exam in general?
Well, we've studied this at length. I can tell you that the average student at Surgent studies less than 95 hours. So that's average. I had a student just recently pass audit with a 92, only having studied 48 hours. And that student in particular had finished college, had just taken an auditing class, and had a lot of base knowledge. And I bet in this audience there are a lot of people who have work experience or who have had a great, intermediate accounting teacher, and they may know that topic really well. This program is ideal because you have such a strong foundation. You don't need to rehash everything. You just need to figure out what it is you don't know. And it's so hard for candidates to do that. I'll say something that's really obvious. You don't know what you don't know because you don't know it. And we'll figure it out for you. So it's hard for me to say everything's the same, but I can give you that average of 49, of 95 hours. And some students are studying less, and some students may have to study more, but that's pretty typical. So you could be done in less than a month if you can devote, 20 hours, 20 plus hours of studying, depending on how much experience you have with the topic.
I imagine that that might cause somebody to take a very serious look at Surgent, even if they had bought another product. You guys have an offer for students who have previously enrolled in other review courses.
We do.
Can you talk about that?
Sure. Um, I know that people have failure, and that's unfortunate. There's nothing worse than getting a 74 or a 70. And so we offer a really great program for people who have tried another product and haven't been successful. If you have used another provider and you need to enroll in another review course, we'll give you a 50% discount off of our enrollment. And we even allow students who buy all four with the 50% to pay in installments. If you just need one part, let's say you've maybe passed three, but you haven't had success in one or more, we give a 33% discount off of an individual section. So if you need the whole course, we'll give you a 50% discount. And if you just need one or two or three parts, we'll give you a 33% discount.
That's really interesting. I'm glad that we were able to bring that out. Okay, so we've had so many questions that were about the tests and Surgent. We also had questions about bonds. So I wondered if we could ask a couple of those, because I know that folks are waiting to get answers on this because they wanted to close the loop here. But the first question I saw on the bonds was if the interest payments and interest expense are different, how do you balance the journal entry?
It would be with either a discount or a premium. So interest expense and interest payment would be the same if the bond is issued at par. But if a bond is issued at a discount or premium, they will not be the same. So you would debit the interest expense, credit interest payable or cash, and then the difference is your plug. And if it was a discount or a premium, you insert the discount or premium amortization for the difference of the two. So that's why you have the interest expense and the interest payment not being the same. And that's most often the case on the CPA exam. They're not going to be the same.
Got it. The other bonds question that we had was it was on one of your previous questions, and so I don't exactly have the context, but maybe you can fill in the blanks.
Sure.
If it was due on 11/1, why is the amortization as of 10/31 if you have not paid it yet?
Well, that's a good question. Usually what happens is companies will close their books monthly. And so they will, at the end of the month, so October 31st, they're going to want to prepare all the adjusting and all the entries they need to bring their financials to date. So what we would normally do is at the end of the month, October 31st, we would accrue for all of those expenses. Even though they're not making the cash payment until November 1st, they should accrue the costs by the end of the month. So that's why we do that.
Awesome. So I think that might be it, unless anybody from your team has any other questions they want to send this way. Well, I would like to close with one general question, Liz, because you've been teaching the CPA exam and had such great success with this for years. And I want you to boil down just one piece of general advice that you would give to CPA job seekers. What is that one piece of special advice? And after you answer that, I do have one more quick question for you. But what's that one piece of advice?
About the CPA exam?
About, yeah, what one thing, if you had a chance to tell anybody who's taking the CPA exam, what would you want to tell them?
Don't put it off. Take the exam as soon as you can. If you are in the fortunate position that you have just graduated college, then you should take the exam right away. You know, I I'm a teacher, and I pose this to my students: would you like to take my final at the end of the semester, or would you like to take a year off and then take my final? No one wants to do that because they can't remember. How quickly did you forget something when you studied it in school? After you take a test, the day two later you've forgotten what you studied, and that's the case with the CPA exam. Candidates need to know that it's an entry level test. It's not a test that you're going to be able to ace with years and years of experience. In fact, I think it gets harder as you get more advanced in your career because you simply don't have the time to study. Your life gets more complicated and you don't have the time. So there's no better time than now to take it. And once you decide to embark on this program, don't give up.
Yeah.
And don't look up until you're done. So devote 4 or 5 months, 6 months max, and knock out the whole exam. Get it out of the way. You'll be very happy to have it over. I know for sure. But what candidates have to realize too is the sooner you pass, the sooner you're going to get that bonus, the sooner you're going to get a raise, and every raise you get from that point on is going to be based on a higher base. So your earnings potential expands significantly once you pass the exam. And why not get that done now? Why not begin that journey now? You'll have a better life. You'll get your life back.
All right. One last quick question, and I'm going to ask for a quick answer, but I felt like it was important to get out. And one of the students is taking the auditing exam at the end of this month.
Mm-hmm.
Any changes in the simulations or other changes?
Yes, the document review simulations are going to be tested as of July 1. Although I do think I've heard through the grapevine that there is some pre-testing going on with the DRSs. So if you want to get experience with the document review simulations, we already have them in our software, and students can practice them with our program. From a standard standpoint, there isn't anything new that you have to worry about. It's just that new sim that they've told us they're going to introduce. So it's officially going to be tested on July 1 going forward, but I wouldn't be surprised if you saw it sooner.
Liz, we've gotten multiple comments that you don't see that compliment you on your teaching style and how you are educational, but also put people at ease and have a nice delivery. And so and I couldn't agree any more with that. And I really appreciate the time you put into building this presentation for us. And I want to say thanks for the offers that you have generously made for our students. Just so you're aware, Deanna from our team is sending those offers out once again. So you can, before we end the webinar, please click on those so you can learn more and follow up with Surgent so that you can investigate this and get. But most importantly, I hope you'll consider them because of the great teaching that you know that you would receive. Before we wrap up, I just want to call out a couple other things. If you are looking for any further education, like when it comes to a master's degree, if you need a master's degree to get the hours to pass this exam, check out Accounting Fly's Master Finder. It's got a lot of resources available just for you guys on where a good place to get a degree, why you should get a master's, what the pros and cons are for things like that. So please check that out. And yes, the slides will be made available. A few people asked about that. We'll be happy to send those out after the presentation. And that is it for now. So Liz, before I wrap up, I wanted to say thank you so much for being here. You did a great job, and as always.
Well, thanks for the opportunity. I look forward to helping you all become CPAs.
And I know that you do a great job doing it. And everybody, thanks. Have a great afternoon. We'll see you tomorrow back again. I think it's 11 o'clock Eastern. You'll be getting a notification from us. And please do click on these links because I'm going to end this webinar, and then you won't have access to the links until we email them to you. So click on those. We'll end the webinar, and we'll see you down the road. So this is Jeff Phillips at Accounting Fly. Bye for now.
Bye.